Before we begin this podcast, we'd like to remind listeners that Netwealth is licensed to provide general financial product advice only, and that this podcast isn't tailored to any particular person's objectives, financial situation, or needs. Before a listener acts on any advice in this podcast, they need to think about whether it's appropriate for their circumstances or their clients, and consider the product disclosure statement for any proposed investment, and also seek any professional advice they need. Netwealth Investments Limited is the issuer of Netwealth's financial products. For Netwealth's financial services guide, contact details, and other information about our products and services, you can visit our website at netwealth.com.au. Today's podcast guest is a financial product issuer. Netwealth and the guest have a commercial arrangement that enables investment in products managed by the guest through Netwealth's platform. Under that arrangement, Netwealth may receive fees from the podcast guest. More information about the fees Netwealth receives is provided in our financial services guide, which is available on our website or by contacting us. Welcome to the Netwealth Portfolio Construction Podcast, brought to you by the Netwealth Investment Research Team. In this podcast series, we pick the brains of key wealth management professionals to uncover opportunities and challenges for investors on a diverse range of topics. We hope you enjoy their unique perspectives.
Welcome to Netwealth Portfolio Construction Podcast Series. My name is Leader Sima Tupang. I'm a member of Netwealth's Investment Management and Research Team. One of my key responsibilities is to manage and govern investment options available in the Netwealth Superannuation and IDPS menu. Today, we have the pleasure to speak with Garry Laurence from Perpetual Investments. Garry is the portfolio manager for the Perpetual Global Shares Fund. He has been managing this investment strategy since 2011. The fund is available in Netwealth investment platform. Good afternoon and welcome, Garry.
Good afternoon.
Garry, we'd like to talk about your investment strategy, gain your insight about the development in global economy and equity market, and your current portfolio positioning. To begin with, can you please describe briefly the investment philosophy underpinning Perpetual Global Shares Fund?
Sure. So we're value and quality investors. So what that means is that we look to buy high quality businesses at opportunistic high discounts to what we think is fair value. So when I talk about quality, what we look for are businesses that have really sound management. So management that have shown a good track record of delivering in the industry that they operate in, also allocating capital effectively. And then when we look at the businesses, we look for businesses that have high barriers to entry, high quality services and products that they sell, and then simply businesses that generate recurring earnings. So we want businesses that have high free cash flow, where that cash flow is reinvested at a high return, either back into the business or alternatively used to make acquisitions, which increases the earnings profile of the business.
Right. Can you please explain more on what is a value style investing in an equity portfolio context?
Sure. So there's lots of different definitions of what value means, but what I'd say is it really is just what the word means. So value investors look to value the business and try and figure out what that business is worth and then buy that business at a discount to what you think it's worth. What Benjamin Graham and Warren Buffett would say is a margin of safety. And so value investors come from that profile of investing where you're trying to get a bargain for what you're buying. Whereas if you look at growth investing, it's more about buying businesses that you think will keep growing without a really strong view as to you're buying it at a discount to fair value.
Right. So it's more looking at the intrinsic value of the company.
That's right.
Right. There is a term value trap. Can you please explain what it is and what you do to avoid value trap?
Sure. So value trap means generally is used when people buy a cheap stock, so maybe a low PE, for instance, and that stock doesn't go up for whatever reason it might be, because the business has structural problems. The industry itself might have structural problems. It might have poor management. And generally what happens is rather than the earnings growing, the earnings might actually start to go backwards and then the stock price will fall. And it gets labelled a value trap because the stock price doesn't go up, even though you're buying it at a cheap valuation. And so what we try and do to avoid that is to buy, really focus on those quality businesses where we are seeing earnings growth, and where we think that we're buying it at a discount to where the stock is or the industry is historically traded at, but there's actually nothing wrong with the business. And you know, the way that we avoid value traps is we don't buy into structurally challenged industries or businesses. We're actually looking for structural winners. But the way that we buy those quality businesses at discounted prices is we buy them when there's fear. So there might be fear due to fears around the global economy. There might be fears around a particular geography, or there might be fears around the business. We might be part of the business, which causes stock to sell off. And that usually provides the opportunity to buy the high-quality growing business at a value price.
Your portfolio normally holds 20 to 40 stocks, which is a relatively concentrated portfolio. Can you please walk us through how your team built conviction to companies you are investing in? Probably provide with some example of current names in the portfolio.
Sure. So the way that we build conviction is we do a lot of research. So we've got a team that travels the world, and we'll meet the management teams of the businesses that we are invested in, but we'll also talk to unlisted players. So we'll talk to competitors, and we'll also talk to their customers to get a real understanding as to the business itself, the products it's selling, and what the customers think of the quality of those products, and whether they'll be taking market share or losing market share, but really getting a rounded view of the business and the industry. So maybe just to give you an example. Sure. So Whirlpool's a company that we've known for quite a number of years, and most people will know their products. So they're a leader in white goods globally with the Whirlpool brand, with over 30% market share in refrigerators and washing machines in the US, for instance. But they have a collection of different assets, which is not just those big white goods. They also have a kitchen appliances business called KitchenAid. And what really interested us about Whirlpool is that when we bought in recently, it was trading on a P of 7 times earnings. And at Perpetual, we've been shareholders in companies like Breville Group in the past, where I remember we were invested in Breville and we owned 15% of the company in the GFC, and it was trading on a P of 3 times. Today, the stock trades on a P of 35 times. So we don't own Breville anymore, but we bought into Whirlpool with a view that the business is not being fairly priced by the market. So it trades on 9 times earnings. But if you were to value the KitchenAid business, which is very similar to Breville, you could easily put that business on a 15 to 20 times multiple. It also has a collection of assets around the world. So Whirlpool's listed in the US, and the US market's really focused on their North American business, but they don't appreciate the value of their assets around the world. So they've got a business in India where they're one of the leaders there. The Indian business actually listed in India, which most of the US stock market doesn't realize. And that Indian business trades on a P of 40 times earnings. Right. It's actually worth a quarter of the market capitalization of Whirlpool today, but is not being priced. But the Whirlpool business listed in the US is not being priced that way. They also are leaders in Brazil, have quite a large European business. And so we just think that there's a real sum of the parts story where the value of the business is worth a lot more than this current stock price is reflecting. And so we've actually been actively engaging with management. We wrote a letter and handed it to the CEO and chairman, just sort of, suggesting some capital allocation decisions that would help them improve the value of the stock today.
Before we bring you the second part of this chat, a little bit about who we are. Netwealth is an ASX-listed company established to help Australians take control of their financial futures. With a wide range of super and investment accounts, a huge variety of investment options and market-leading online tools, we can help you manage your wealth your way. Partner with us to see wealth differently and discover a brighter future. Visit the Netwealth website to learn more and get the PDS, which you should read before making a decision. Products issued by Netwealth Investments Limited.
You manage your portfolio unaware to the benchmark. What does benchmark unaware means in portfolio management, and how do you manage risks in the portfolio?
Sure. So benchmark unaware means that you don't really take too much focus of, the direction of the benchmark that you're being judged against. And so for a global portfolio, you tended to be benchmarked against the MSCI World Index, which has, thousands of stocks in that index in countries all over the world with lots of different currencies. And so I manage a concentrated 20 to 40 stock portfolio. My portfolio really is going to move differently to that benchmark, which has thousands of different stocks in different industries, different currencies. And the focus of the portfolio I manage is basically just to buy these high quality growing businesses and really just to generate absolute returns for the investors. It's just going back to basics and saying, well, why do we invest? We invest to make people money. And we just want to buy businesses where we think will make people money over the medium and long term, but also reduce the risk of them losing money. So, we go back to that value investing philosophy of just look at the margin of safety, look at the recurring nature of the earnings stream. And your real risk in buying businesses is buying businesses where that earnings stream will fall, as well as overpaying for the businesses. So we feel that, if you reduce those two risks, then you'll make money over time. And being benchmark or unaware means, we shouldn't really be worried about what's going on in different stocks that we actually don't own.
Right. Okay. Thanks for that. You can hold up to 25% position in cash. In what circumstances will you be close to this allocation limit?
Sure. I guess I'd probably move closer to that 25% cash limit when I felt that, firstly, there weren't any good opportunities to deploy that cash. And then secondly, if I've got a strong view that, the risk return over the next year is that there's a bigger chance of markets falling than going up. So, we've never really allocated that much to cash since inception in 2011. And the reason being is that we haven't had a view that a recession is impending. If we did have that view, then the cash levels would increase.
Right. Okay. I think it's a good segue to the next sort of question I want to ask. Moving to global economic development, we've been hearing some market commentators are suggesting that we are currently in the late economic cycle. What is your current view on the current economic cycle?
Yeah, so I agree that we are probably late stages in the economic cycle, but it's really hard to know when it ends. So the CEO and chairman of JP Morgan stated recently a couple of days ago in their earnings result that, we're late stages in the cycle, but that doesn't mean that the cycle will end in 2019 or 2020 or even 2021. It's at the moment, if you've got low interest rates, that if the consumer is healthy, if people are employed, then that doesn't mean that you won't continue to see economic growth. So you really need a shock to the system, some sort of, unforeseen shock to cause a halt in the cycle.
Right.
But there are differences between the economic cycle and stock markets, and stock markets will try and predict the end of the cycle. And when they do, if they do think that we're at the end, then you see stock markets falling. And that's what we saw in the December quarter,
right,
where the markets fell 11% because people were worried that we're at the end of the cycle. But then once people realized we're not, then the markets bounced back and regained all the losses.
Right. So I think that's the reason why of the recent market volatility, where December quarter benchmark was down by about 11%, and the March quarter 2019 is going up again. So it's probably because of the market just overreact about the position where we are in the
that's
cycle.
right. I mean, basically companies came out and reported their results, and the results were fine. And so the market, moves on sentiment, and in that period there was a lot of negative sentiment. And then once you actually saw the data, it was evident that actually the global economy, even though it's slowing in terms of its growth rates, it's still growing.
Do you have any advice for any value investors to invest in the current economic condition?
Yeah, so what we would say is you probably should look at some defensive parts of the market and sectors where those businesses will do well irrespective of the economic cycle. So what we've done is we've increased our weight to consumer staples, looking at healthcare businesses, certain industries that the earnings don't actually fall during weak periods of economic activity. We also would recommend that people are looking at valuations and looking at how valuations have trended over decades. Don't just look at how a stock is trading today versus another stock which is quite similar. Have a real think about, how has that sector actually traded over 20 years? And, if it's trading at, really high levels versus that historic average, there's a good chance at some point it will go back to the average. So, just really having a good think about, what is a fair price for a business that you're buying, and then think about how cyclical the earnings stream can be. And, if there is a period of weak economic growth, what do the earnings do of the business that you're buying?
Thanks for that, Garry. Lastly, can you please share your investing rules or tips for our listeners based on your personal and professional investing experience?
Sure. I guess some of the tips I would give is, firstly, you learn from experience and you learn from practicing, and investing is like a sport. So the more you do it, the better you get. Secondly, I would say you've really got to look at the financial statements. So if you haven't been trained to read an income statement and read a balance sheet and look at a cash flow statement, you're investing, with a view as to how you think the business will go over time, but not a strong view as to what that business is actually worth. And also, you're not really got a strong view as to its level of indebtedness or the risks that the business is taking, its capital allocation policy. So what I'd recommend is, probably, depending on who you are, if you don't have training in looking at financial statements, then it's probably worth reading up on how to analyze financial statements. If you do, and you're an experienced investor, it's about really getting close to businesses, getting close to management. Invest in businesses that you understand would be the key, and where you think you can get an edge over the rest of the market.
On that note, that's the end of this Portfolio Construction podcast. Thank you, Garry, for your time and insights.
Great. Thanks for having me.
Thanks for listening to this episode of the NetWealth Portfolio Construction podcast series. For more episodes and to subscribe to our series, visit our website www.netwealth.com.au or visit the iTunes Store or Spotify. We hope you can tune into our next episode.